Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Arista Networks.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So you are staring at a classic Wall Street paradox today. I mean, imagine looking at a quarterly earnings report that is just glowing green across the board.
Well, absolutely. It's wild.
Yeah, Arista Networks just delivered this Q1 2026 earnings beat that, honestly, it completely shattered expectations. They pulled in $2.709 billion in revenue.
Which is massive.
Right. And guidance was raised. The future looks incredibly bright. And yet, the moment the market closed, the stock just plummeted. We are talking about a precipitous, 10 to 14% drop in after-hours trading.
Yeah, it's the exact scenario that induces total panic. If you're just watching the ticker symbol flash red on your screen.
Definitely.
Because you have this phenomenal business update colliding with a deeply pessimistic market reaction.
Which forces a really critical question for anyone trying to navigate this market. Is this post-earnings gap down a flashing warning sign for you? Are we looking at an overvalued tech darling that is, finally running out of steam?
Or is it a shakeout?
Exactly, a shakeout. Is this a rare manufactured entry point into a foundational business? Because when a stock drops double digits on genuinely good news, it's usually the algorithmic momentum traders fleeing, right? But the fundamental mechanics of the company might actually be accelerating.
Which is exactly what we need to figure out.
Right. So we are going to unpack the financials, the underlying AI technology, and the chart to figure out exactly what is happening under the hood here. All right, let's move into the wealth building context.
Yeah, because to understand why Arista Networks is reacting this way, you really have to zoom out. We can't just view this as a quick tech trade to flip next Tuesday.
No, definitely not.
You have to view this through the lens of infrastructure. If you are constructing a portfolio designed to capture the next decade of technological growth, you have to look at the plumbing. And Arista Networks is positioning itself as a core foundational piece of that plumbing.
Well, plumbing is actually the perfect word here, but we aren't talking about standard pipes anymore.
No, not at all. They are the premier play on the convergence of Ethernet and artificial intelligence data center networking.
Right, because the hyperscalers, those massive cloud providers running the internet, they are building colossal AI fabrics. And the network architecture required to support that, it's undergoing this evolutionary leap.
It really is.
Yeah.
We're talking about the transition to the 1.6T Ethernet standard alongside something called the XPO standard.
The extra dense pluggable optics.
Exactly, the extra dense pluggable optics standard. And we should probably break that down because 1.6 terabits is just a staggering amount of data throughput.
It's insane.
Think of it this way. Upgrading from standard office networking to AI data center networking, it's like upgrading a city's water supply from standard, plumbing pipes to massive high-velocity aqueducts.
Yeah.
AI models don't just consume data, they absolutely flood the system with it.
Right. When a hyperscaler is training a large language model, it requires thousands of processors all talking to each other simultaneously.
Exactly. And the cost of that compute is astronomical.
I can't even imagine.
Really?
Millions, right?
Yeah, literally millions of dollars an hour to train.
Oh.
So because of that, the network connecting those processors, it simply cannot blink. Zero downtime architecture is no longer just some premium feature.
It's completely non-negotiable.
Right. If a single network switch fails, or if a data packet drops and creates latency during a massive training run, you don't just experience a laggy video call.
Yeah.
You lose millions of dollars in highly expensive GPU compute time.
Wow. So hyperscalers are essentially forced to buy the absolute best-in-class hardware no matter what.
Exactly, which creates a multi-year hardware deployment cycle. And if you are a long-term investor, well, that is a cycle you want exposure to.
Now let's look at the fundamentals, because the macro environment is clearly a massive tailwind, but the actual velocity of this business is genuinely impressive.
It really is.
Arista delivered 35.1% year-over-year revenue growth. They blew past their previous $2.6 billion guidance.
Which is huge on its own.
Totally.
Yeah.
But the metric that really stands out to me is their AI-centric revenue. Management just doubled their full-year AI revenue target to $3.5 billion.
Right. So they aren't just, participating in the AI boom. They are capturing the exact segment everyone wants to dominate.
Yes, and they are doing it with remarkable efficiency, too.
Oh, absolutely. Their non-GAAP diluted earnings per share came in at 87 cents. And just for context, that is a significant jump from 66 cents a year ago.
Wow, so a huge leap.
Yeah, it demonstrates incredible operating leverage, which just means that as their revenue scales up, their costs aren't rising at the same pace. So, more of that money flows straight to the bottom line.
Okay, I want to look at their balance sheet next, because from a risk assessment standpoint, this is the kind of data that lets an investor sleep soundly.
For sure.
They closed the quarter sitting on $12.35 billion in highly liquid assets. I mean, we are talking about $2.789 billion in pure cash and $9.563 billion in marketable securities.
It's massive.
And get this, they have zero significant long-term debt. None.
Zero. It's a financial fortress.
Right. Plus, they just posted a record $1.69 billion in operating cash flow for a single quarter.
Yeah, they have the flexibility to navigate almost any macroeconomic storm right now.
Okay, but here is where I have to pause and challenge the narrative a bit.
Oh, sure. What's up?
Because there's a specific detail here that just doesn't quite add up if everything is so perfect. Despite generating this absolute mountain of cash, management explicitly paused their share repurchases in Q1.
Right. The buybacks.
Yeah. They still have $817.9 million remaining under their current buyback authorization. Yet they kept their wallets shut. I mean, if the underlying business is booming and the stock is purportedly a great value, why wouldn't management buy up their own shares?
It's a fair question.
Because usually holding back signals that management sees turbulence ahead or they need to hoard cash for, like, a defensive reason.
It is a very sharp observation. But the explanation actually lies in another section of their financials, specifically the deferred revenue. Their deferred revenue just surged to $6.2 billion.
Okay, let's define that clearly for the listener. Deferred revenue means customers have committed the money, perhaps even paid up front, but Arista hasn't actually delivered the hardware yet, correct?
Spot on. It is a massive multi-billion-dollar backlog of demand just waiting to be fulfilled. So to answer your question about why they paused the buybacks, they aren't hoarding cash out of fear.
Oh, they need it for the backlog.
Exactly. They're holding that cash because they need it to aggressively fund future fulfillment. They have to purchase the highly specialized, very expensive raw components to build the switches their customers are desperately waiting for.
I see. So reinvesting in their own supply chain yields a higher return right now than buying back their own stock.
Precisely. And there's another layer to this, too. Their competitive moat is so incredibly deep that protecting their ability to deliver is paramount. Arista runs on an operating system called ES.
Right, the software stack.
Yeah, it's the software that makes their hardware run so efficiently. And that software has generated a Net Promoter Score, or NPS, of 89.
Okay, wait. For context, NPS is a metric measuring customer loyalty on a scale of -100 to +100.
Right.
Most beloved consumer brands hover around, like, 50 or 60. So 89 is...
It translates to roughly a 94% customer satisfaction rate.
That's insane.
Right. In the world of complex enterprise-level IT hardware, an NPS of 89 is virtually unheard of. Once a company integrates Arista's EOS software into their data center, they do not leave.
The switching costs are just too high.
Exactly. And the performance is too good. Management knows this. They know that if they can just secure the parts to build the machines, they have a customer for life.
Wow. Well, that brings us to the catalyst timeline. Because a strong business with a deep moat still needs a catalyst to move the stock price higher.
Very true.
Looking at the next 3 months, the immediate focal point will be the Q2 2026 earnings, which are projected for mid-August.
Right. And management didn't just beat the Q1 numbers. They raised their Q2 guidance to approximately $2.8 billion in revenue.
And roughly 88 cents in earnings per share, right?
Yes, exactly. And that move essentially forces analysts across Wall Street to open their models and reset their consensus estimates higher.
Okay, but there is a much larger structural catalyst at play here, and it goes back to that XPO standard we touched on earlier.
Right, the extra dense pluggable optics. It isn't just a dry technical specification. It is a strategic weapon.
Okay, let's demystify what that means. In a data center, Pluggable optics are the components that convert electrical signals from the servers into light signals that travel across fiber optic cables.
Exactly.
And doing that quickly without generating enough heat to melt the server rack is incredibly difficult.
It's a huge engineering challenge. And Arista has spearheaded a new consortium to standardize how those optics are built, securing endorsements from over 100 different industry vendors.
Oh, wow. Over 100.
Yeah. And by unifying the networking industry around their specific standard, they are effectively locking out their legacy competitors who rely on a different technology called InfiniBand.
I mean, if we think back to the operating system wars of the 1990s, the company that dictated the underlying architecture won the entire ecosystem.
Spot on.
It didn't matter who manufactured the best keyboard or the sleekest monitor, the operating system set the rules of the game. That is what we are witnessing in AI networking right now.
Exactly.
By leading this official standardization body for the XPO consortium, Arista is elevating itself from a hardware vendor to the architect of the entire industry. They are literally writing the rules for the next decade of AI data flow.
Which is why the recent market reaction is all the more fascinating. Because if their strategic positioning is really that dominant and the demand is historically high, we have to address the elephant in the room.
Now let's pivot to the chart, because the narrative completely clashes with the math.
It really does. The price action has been brutal.
Yeah, I mean, if we rewind to the technical setup just prior to this earnings report, the stock was on an unstoppable run. It was up 87% over the past year.
Incredible run.
And it had surged 34% in just the preceding month alone, closing at $170.22. The momentum was just white hot. But post-earnings, the floor vanished.
It completely dropped out.
It gapped down hard to the $148 level, and it did so on exceptionally high trading volume.
Yeah, this is what technical analysts call a high-volume capitulation event. Think about the psychology here. When a stock runs up 34% in a single month heading into an earnings call, it is priced for absolute perfection.
Right. The market has baked every ounce of optimism into the share price.
Precisely. So what we are seeing is a classic sell the news, profit-taking flush.
So the fundamental business delivered, but the short-term traders who were just surfing that momentum wave decided to, cash out their chips all at once.
That's exactly what happened.
But I have to ask, from a structural standpoint, does a massive gap down on high volume signal that the underlying momentum is broken? Because usually when you see a drop like that, it means institutional money is distributing shares, taking profits, and stepping away.
Right.
It can take months, sometimes longer, for a stock to repair that kind of technical damage.
It certainly can take time to consolidate. However, you really have to frame this price action through the lens of valuation multiple compression.
Okay, explain that.
Well, that violent repricing flushes out the over-leveraged short-term speculators. But by resetting the valuation to a more reasonable level, it actively builds a healthier, more sustainable base for long-term investors.
Oh, so it creates that shakeout pattern we mentioned earlier.
Exactly. The weak hands drop their shares, creating a temporary oversupply. And the institutional value buyers, the ones who love the company but refuse to pay $170 a share, they step in to establish a floor at that $148 level.
Okay, so what does market sentiment look like right now? Because if you just scan the financial headlines, the immediate news flow is undeniably bearish.
Very bearish, yeah.
The media is laser focused on the sudden stock dive and amplifying fears about supply chain constraints, while seemingly ignoring the reality that this was a massive beat and raise quarter.
Surface level sentiment is highly cautious, for sure. But the real indicator you should be paying attention to isn't in the headlines.
Where is it?
It's in the institutional shadow buying, and more importantly, in management's own aggressive deployment of capital. While retail traders were panicking over the after-hours price drop, Arista's management was making massive moves.
What kind of moves?
They just accumulated $2.38 billion in physical inventory.
Oh, wow. And on top of that, they made $8.9 billion in purchase commitments, didn't they?
Exactly. When management commits nearly $9 billion to future inventory, they are signaling, with real capital, that their visibility into future demand is explosive.
They know the orders are coming.
Oh, they know for a fact.
We should also touch on these speculative rumors currently circulating. Because of this industry-wide pivot away from the older InfiniBand technology and toward Ethernet for AI clusters, there's a lot of unconfirmed chatter.
Oh, the M&A rumors?
Yeah. Chatter that Arista could become a prime strategic partner. Some even speculate they could be an acquisition target for major silicon vendors who are looking to vertically integrate.
I mean, it makes logical sense. If you are a major chip maker manufacturing AI accelerators, you eventually want to offer your clients a complete end-to-end infrastructure package.
Right.
So acquiring or deeply partnering with the company that literally writes the networking rules ensures your chips will always have the best possible data pathways.
Now let's talk about the risks. Because no thesis is complete without looking at the dark side of the moon, and the bear case here has real teeth.
It definitely does.
It largely centers around supply chain realities and valuation limits. I mean, management was brutally transparent on their earnings call. Demand is currently outstripping their supply.
Significantly outstripping it.
Yeah, there are severe industry-wide shortages in silicon wafers, specialized chips, and memory components. And because of these bottlenecks, Arista is facing punishing 52-week lead times.
That is just a staggering metric. Imagine a chief information officer finalizing a multi-million-dollar budget for a new AI data center, signing the contract, and being told they have to wait an entire calendar year just to receive the networking equipment.
It completely caps their near-term upside. A company simply cannot recognize revenue for hardware it cannot physically build and ship.
Right.
Furthermore, securing those scarce components in a constrained market is expensive, and we are seeing that impact the bottom line. Gross margins actually dipped 170 basis points year over year, dropping to 62.4%.
Yeah, that margin compression is tough.
Right, so when you combine shrinking profit margins, a 52-week fulfillment delay, and a stock that was trading at 62 times trailing earnings before the drop, well, you have a very real physical bottleneck colliding with a sky-high valuation.
That is the core of the bearish argument, and it is entirely valid.
But
But let's look at how management is actually navigating that bottleneck, because they are executing a brilliant defensive strategy.
okay, tell me more.
Yes, there are severe component shortages, but remember those $8.9 billion in multi-year purchase commitments we discussed.
Right.
That is Arista flexing its massive balance sheet to secure component allocation that their smaller competitors simply cannot afford.
Wow. Okay, so they are taking a macroeconomic headwind, this industry-wide shortage, and weaponizing it into a competitive moat.
Precisely.
If a customer needs a massive Ethernet deployment, they almost have to go to Arista, because Arista is the only vendor with the financial muscle to guarantee they will eventually get the parts, even if it takes a year.
Exactly. Smaller rivals will just starve for components. They're outbuying the competition to secure their place at the front of the manufacturing line.
And what about that margin compression, the dip to 62.4%?
Well, it's important to understand why that is happening. They are actively choosing to absorb those temporary supply chain price hikes themselves rather than passing every single cent onto their customers.
Oh, which goes right back to that 94% customer satisfaction rate.
You got it.
They are willingly sacrificing a tiny slice of short-term profit margin to ensure their customers stay happy and remain locked into the EOS software ecosystem for the next decade.
It is a long-term play over short-term optics.
So with everything on the table, what's the final verdict?
Well, with all the fundamentals, the technical damage, and the supply chain realities on the table, the research assigns this a bullish score of 8 out of 10.
8 out of 10. Okay.
Yeah, the core thesis is straightforward. This company is the premier infrastructure play on the AI data center networking revolution. The underlying demand is, quoting management directly, the best ever.
Right.
And through the XPO consortium, they just locked in a multi-year architectural advantage over their competitors.
To synthesize this for you, yes, the short-term margin pressures are real. Yes, waiting 52 weeks for equipment is frustrating and it caps immediate upside. But the post-earnings plunge effectively compressed the valuation multiple.
Exactly.
It took a stock that was priced for absolute perfection and applied a massive sudden discount to it. If you are looking at a 12 to 24-month horizon, this creates a compelling holding opportunity.
It really does. It allows an investor to ride the massive 1.6T Ethernet deployment cycle, buying into a fortress-like balance sheet during a moment of temporary algorithmic panic.
It ultimately comes down to your investing psychology. Do you require the comfort of a clean, perfectly linear chart that only goes up?
Which doesn't exist, by the way.
Right. Or are you willing to step into the muddy waters following an earnings drop, look past the immediate red ink, and recognize the billion-dollar foundations being poured for the future of AI?
Exactly.
It leaves us with a fascinating final thought to consider. We spend so much time obsessing over the companies making AI computer chips, right? But if the physical speed of data moving through fiber optic cables becomes the ultimate bottleneck for achieving artificial general intelligence, then the company that controls that network traffic might eventually wield more structural power than the companies making the processors themselves.
That is a wild thought.
Something to mull over as you watch this sector evolve. Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.